Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. Today I'm joined by Sean Henaghan. This is the actual 100th episode of the Market Narratives podcast series, and actually it's a great opportunity to bring back the first guest that we had on the series. Sean, welcome.
Thanks, Alex. I think it's incredible to think it's been 100 episodes since we had that first one. Congratulations, mate. That's really impressive.
Well, thank you. It's probably a bit of determination, and it's COVID. And just a curiosity to just go and reach out to as many people as I can, talk about as many different parts of the market as I can as well. And it's a good opportunity to really broaden out people's ability to talk about anything, particularly when you can't travel. There's not really the same amount of events and people are looking to share their views.
Right.
Now, last time that we spoke, you were, I think, actually trapped in Whistler. COVID was starting to hit and you were looking to try and work your way back out of Whistler to come back home to New Zealand. What actually happened since then?
Yeah, so we finally we got to do a bit of travel in Canada. The COVID came out. They opened up enough for us to get in a car, and we did 10,000 kilometres up through British Columbia, Alberta, and up into the Yukon. So we got up into a couple hundred kilometres from the Arctic Circle, 24 hours daylight. Which was pretty cool. And then, end of August, early September, we came back to New Zealand. The plan was to have a month here in New Zealand, then come back to Aussie and start to sort of have a look around, see what opportunities there were. But we did our 2 weeks in quarantine in New Zealand. And at that stage in September, they hadn't opened the travel bubble with Australia. And I could not do another 2 weeks in quarantine. I just found it incredibly hard, given the not working, just trying to occupy yourself for 2 weeks. It was pretty tough.
I think throwing a tennis ball against the wall after a while gets pretty boring. So you need to start doing things. But as a guy who follows the markets, there should have been something there that was interesting for you to do.
Look, and I did. I read as much as I could, but even trying to read all day is pretty hard work. I watched some pretty interesting series on YouTube or Netflix. I did the history of the Roman Empire, which was pretty cool. And then, but then I started to reach out to people. And so we made a decision. So, we came back to New Zealand because I had my first grandchild born here. So I thought, I said to my wife, let's just have a look around New Zealand. We both got aged parents here in New Zealand and having a grandchild. I said, maybe let's spend a few years in New Zealand if there's an opportunity. I reached out to a lot of people. And when I got out of quarantine, I started having face-to-face meetings. And I said I'd sort of shake the tree till December and see what opportunities presented themselves. And a young guy reached out to me. He had a fairly large distribution business, distributing some other people KiwiSaver. And he said, would you like to build our own KiwiSaver? And so I spent several months doing DD. And that's where we're progressing now. So we'll probably get our first customers in 2 to 3 weeks. So we've gone through that process. Yeah, so it's pretty amazing how things pan out. I had no intention of ever starting my own business. That was never on the radar. But suddenly, COVID deals you a hand and you play the cards you dealt, right? So I'm now sort of starting up a KiwiSaver, and it's really exciting, Alex. It's actually putting into practice a lot of the things that I'd learned over the years, working both in consulting and with Aurora Capital. And so there's a bit of a story there, which maybe I'll talk through.
Look, I'm happy for you to give a bit of context in it. Obviously, given your background, in portfolio management and always very curious to push the dial on things, I'm curious to see how would you approach KiwiSaver?
Yeah, so look, it was interesting. So when I was running the multi-asset business at Aurora Capital, the AXA AMP merger happened, and we had IPAC come into our business. So, it was interesting that sort of initially we were a little bit skeptical of the IPAC approach, but within 2 years, or even less time than that, actually figured out they had it right. And so what they did, maybe this is a little bit harsh, but I think this is my perception. What we did is, so we highly paid, pretty affluent fund managers sitting in an ivory tower, building really smart investment solutions, and then going to the customer or the client and saying, and I'm talking retail here rather than institutional, and going to the client and saying, swallow this, it's really good for you. Whereas the IPAC approach was, so all the portfolio managers in the IPAC business had real proximity to the advisors. They spent a lot of time with the advisors. They got to know and understand the customer need, and then they'd build a solution to meet that customer need. And us on our ivory tower would look at that solution and think, oh yeah, that's no good. But what we failed to understand was that solution wasn't designed for us. It was designed for a very different customer. You have to start with the customer need. Don't sort of start with this wonderful solution without fully understanding the customer need. And that customer proximity is really, really important. And so what really attracted me about this opportunity that I'm in is that we're creating effectively a vertically integrated business model where me as the portfolio manager is going to be sitting and spending a lot of time with the advisors. And so I'm trying to embrace the IPAC approach where that sort of, I see that advantage as, that proximity is an advantage. Now, the model in Australia, a lot of those aligned channels are, well, there's this conflict of interest. There's this conflict issue, the independence. And I always had the view that if you want to buy a BMW car, you don't go to a Ford salesman. But so the model in Australia is okay, you've got to have these independent advisors. So the problem with that is that independent advisor, in sitting down and understanding the customer need, has to effectively know the whole market to try and understand how to build a solution for that need. So how do you understand what the sort of 50, 60, 70, 200 investment products out there, how do you have that real knowledge about what they can provide and what they do? Okay, sure, you could use consultants and advisors to rate. But what ends up happening, there's so much, again, focus on past performance. And, we both know that actually past performance is a very poor indicator to assess and pick managers. The noise to skill is such that you actually, it's proof of process. It's not evidence of skill. And so I think the model where you have proximity so the advisors will speak to me all the time. They'll understand exactly what I'm doing and why I'm doing it. I'll understand their need, understand the issues that are front of mind for their customers, their clients. We can just make sure that communication is really, really tight. So what we're doing is we're going to really focus on having effective communication. Now, the solutions that we're building, we're going to have a real ESG and climate focus. I think climate change is something that is just so important. I mean, it's a little bit flippant, but you make the point that, well, why, as a 25-year-old, why save for your retirement at 65 if this, you're potentially not going to have much of it's a bit dramatic. Yeah, sure. But, this thing is really, really serious. And the more I've investigated and got into it, the more I realized just how important it is. So, and the other thing actually, Alex, is quite interesting. Like we had a ESG fund at Aurora Capital, and I've effectively been out of the market for 2 years. And it's incredible in that 2 years how far ESG has progressed. It's gone from being, well, more than fringe, but it's just so mainstream now. So we're having a real focus on ESG as well. But the interesting thing about this climate focus is we're trying to partner with a startup here that offsets carbon footprints. Mm-hmm. So we can try and get all our members to offset their carbon footprint, as well as we're creating a fund that's going to not only avoid the bad stuff, but invest in newer technology that potentially helps the climate. So it's not just avoid, it's also invest. And we're just going to try and make a real focus on this climate because our research shows most of our potential clients are in the sort of the 25 to 35 age group. Climate really matters for them. And so what we'll be doing with our reporting is just not reporting on performance, but reporting on climate metrics. Show what the carbon footprint of the portfolio is, how it's changed, and a few other sort of climate-related metrics to try to say, okay, I think the other point that with IPAC is, I think it's really, really hard to build loyalty purely on performance. I think there's a cliche about you live by the sword, you die by the sword. So we want a much deeper level of, well, not deeper, but a different form of loyalty, which is built around aligned beliefs. So be very clear and articulate what your beliefs are, and then just reinforce that through your reporting, communicating. I'm a bit worried that I'm doing all the talking here.
No, well, don't worry. I've taken down a lot of notes because there's quite a few things that I'd really like to pick you up on. Before we go down the ESG path, because I think that's a real minefield to go into.
Absolutely.
I want to go back to your ability to deliver product solutions to individual clients, and one of the biggest challenges around the cost effectiveness of doing that, and this targeted individual style client approach. How do you deal with that?
Yeah,
problem?
Look, I'm not sorry. So I think our cohort of investors are reasonably homogeneous in terms of average income 50,000, average balance in their KiwiSaver. Sorry, 50,000, 15,000 in a KiwiSaver, average age of 32. most, and looking to buy their first home. That's that's the cohort that we're looking at. So, when I talk about product, it's more for that cohort rather than for individual members. But what is pretty impressive about my business partner is that he has built a advice platform that targets middle New Zealand. So, he can do it cost effectively for someone of that cohort, which is pretty rare. Now, it's not there's different levels of advice. There's specific and there's more the sort of bland advice, which says, okay, you're 32, you want to save for your first home, that should be in a conservative fund, but the stuff that you save for retirement should be in a more growthy fund. It's that level of advice. It's not saying if you want to live off $50,000 a year when you're 75, you've got to put an X. That's far more specific. And they will look to provide that advice, but it's more generic advice. But even that advice is good, because what happened, a lot of the KiwiSaver default funds were conservative funds, because the default providers were saying, listen, we don't want to have a negative return. That's going to spook the investors. So we'll make it a conservative fund. And that's not really where you want to be if you're saving for you've got a 40-year time horizon.
Definitely not if you're 25. So I'm sort of curious then, how do you think about talking people through that? How do you give them enough advice to actually understand that if you're in a more growth-orientated space, particularly as you now start talking about the need to invest in newer technologies, some of these newer technologies do have higher risk and there's higher potential for drawdowns. How do you then sort of explain to the members?
That's about portfolio construction, Alex. And so we've tried to build a fund that is just going to manage that volatility. So we have a core exposure to global equities and emerging markets, and then have a range of thematic funds with a sort of 5 to 6% allocations built around that. So it's almost a bit of a barbell. It's not low vol, but we're trying to manage that risk. And the average growth fund in New Zealand's 80-20. And we've made this fund 70-30 just to try and dampen that volatility. So, there's more about the portfolio construction. So the engagement with the members more just about saying, okay, this is a long-term retirement. And the other issue in New Zealand with the KiwiSaver here is that people only contribute between 4 and 5%. The contribution rate is although you do have, there's no means tested super. There's super here that's not means tested. So everyone gets superannuation no matter what your balance is. So that sort of helps offset the under contribution, but people still, the contribution rate certainly needs to be lifted as well. But people don't get advice. That's the issue. It's just and it's amazing while we're in the industry, I don't think we quite appreciate how little knowledge there is outside of it.
I think the challenge there is that a lot of the advice people are quite separate from the portfolio management teams. It's so distinct, that group. And then the people that are sort of trying to help bridge the gap between the portfolio manager and the advisors is some marketing person that probably has no idea about the real investment strategy or understanding that level of communication. It's a very different person that sits in between those two groups.
Yeah, well, I'm doing both effectively. It's not a big business. There's probably sort of 80 odd advisors, 65 to 70 advisors. And so part of what we're trying to make sure happens is that flow of information is seamless. Once the business starts to get more scale, obviously you have to think about that. But at this stage, and that's something which I'm really excited about, to be honest, Alex, it's always getting out and sort of meeting your clients is something I've always enjoyed. My last role running the multi-asset group, I just didn't get to do that. I was just dealing with running the business really, which is a very different. So being in a startup is exciting. And actually being in the startup, it's made me realize how little I know. Once you're getting into the weeds and dealing with your custodians and your administrators and it's all this sort of stuff that I've just got very little knowledge on. So it's been pretty steep learning curve for me as well, but I'm really enjoying it.
Well, it's very different, obviously, when you're in such a large business where everything is very much institutionalized. You've got very clear delineation of people's roles within the business. It is very easy to just become disassociated and literally sit within your silo and not really have to worry about any other part of the business and just assume that someone else will take that responsibility.
Yeah, and the average age of the company, the average employee age is about 28.
Jeez.
And so I bring that up. Without me, it would be 27. So it's so different, and it's really it's so much fun. It really is. I really do enjoy it.
Let's come back to the ESG components, because I think that's one of the areas that is still very much in flux. There's a lot of interest. I don't think anyone would raise their hand and say, look, I'm against supporting the climate. I'm against trying to do what I can within my portfolio. But the challenge is how to actually do that effectively. You mentioned one case in terms of carbon footprint. There's a lot of other different ways now in terms of approaches that different people, the investors, can say, what values do I support? It almost becomes a value-driven piece, right? Because climate is just one part of ESG. There's issues around company transparency, racial equality, gender equality, customer safety, ethical leadership. There's all sorts of things. We've got SDGs as well. How do you then try to build different portfolios that almost align with people's different values, which is where we're seemingly going to?
Yeah. Look, and so as a startup, our options are very limited. I reached out to some people I know in Australia and saying, listen, this is what we're looking to build. What are the options for investing in some of your funds? Even though it's a European listed UCIT, minimum investment is 25 million. Okay. We're starting with zero. So what we're white labeling a couple of funds for domestic manager here that is highly rated on the UNPRI. So they have the highest rating in New Zealand on UNPRI, along with the New Zealand Superannuation Fund. So that, they've got credibility there. And then I'm building a climate change portfolio using BlackRock ETFs. But I understand what you're saying. But I think that people are on a journey here, and I think I believe in what the objectives are. I think everyone's got to get far better at how we measure. There's talk about greenwashing, right? That's the big thing now. But I think often with some of these things, there's a lot of skeptics that throw stones because they're quite comfortable with the status quo. But, take climate. Okay, I might be naive, but take climate. I think, as you said, whatever happens, it's got to be good to treat the climate better. That's a base case. I think it's far more serious than that. And I think we don't really have a choice. So my belief is that I believe it's the right thing to do. And let's worry about, are we perfect with it? That's a second order challenge as far as I'm concerned. I'd rather be trying to do the right thing and maybe not doing it properly, but at least we're making an effort and we'll get better with it over time.
As long as we're not virtue signaling, because I think that's very dangerous in this current environment. And it's something,
completely.
It's something that really bothers me, because a lot of people wave all sorts of flags and are quite hypocritical. Ultimately, they'll wave a particular flag, and the way they behave and act day to day is really distinct from what they're professing.
Yeah, and that's one of the things that I've said to my business. We need to be authentic, because especially the Gen Ys and the Gen Zs, they can smell when people aren't being authentic. I think their radars are really strong at this, and there's nothing worse, absolutely, as you say, to be professing to be the sort of the best in class, whereas it's not authentic. You can't talk about being a climate thing and focus and then drive around in a sort of 6-litre car, right?
Oh, look, we've got people like that drive around in Land Cruisers and so forth that are very, very pro ESG, right? That's just unfortunately the type of life we live in these days. But the other thing that just came to mind as you were talking about it is really, you can have this process to improve the climate, right? And you mentioned that. Think about the various challenges as you move through the process. It's almost as though you need to explain to the members, how would you actually go about improving your investment process that actually has a greater and greater impact. So you mentioned about ETFs, right? You mentioned sort of BlackRock ETFs is one way. Some people then criticize, okay, that's the start, that's passive. How can you then be more active? How do you then go to different technologies, different sectors? How do you then go to private investments?
Absolutely, and that's our journey. As we get scale, we intend to get far more active, and ideally, I'd like to. I think there's New Zealand. We'd like to bring managers to New Zealand that we can partner with, put into our portfolios, but also offer to the New Zealand marketplace. And so I think Australia will be an attractive place to identify and find those managers. Australia is a much, much larger market, and so we've, as part of as we communicate with members, we'll talk about our journey. We're on this journey together. This is where we want to get to. But at the moment, our scale limits the opportunity set that we can take advantage of. But certainly, as we evolve, we want to be have far more ownership in terms of how we do this. But as a small startup, the options are somewhat limited, particularly in New Zealand.
How much do you also think about the current market environment? In terms of being a startup and trying to get people in? Because obviously, I know track record is no reflection of the future, but you've got a situation where people are pretty much on tender hooks as to whether markets are overvalued, both equities and bonds. You're starting a new business. The risk is you get some drawdown. How does that sort of play into your
Yeah,
framing?
and look, and I think where we're fortunate is, as I've said about our cohort, they're 32s. So actually, a big market correction would be a good thing. Perversely, they've got very little money invested, and so it'll be opportunity to invest at far more attractive valuations. And so again, that's the message that we're going to say. Listen, markets may be expensive, but I think there's a look. Quite frankly, I've been worried about markets for 2 years now. And I think it's I think it's probably a good time to have a chat about.
I think I'm 10 years are probably on you, unfortunately.
Yeah, absolutely. And look, and I think it's just I really do worry about it, Alex. I think the central banks are becoming part of the problem now. I just worry that the business cycle, the economic cycle has all been distorted by central bank action. It's just like, I think risk is not being punished. It's just there's, as Alfonso was saying in your last podcast, it's just all these zombie companies being kept alive. It's just creating an environment where if you're going to be doing asset allocation, you've got to be reading the Federal Reserve. Don't back the Fed. It's just it seems to be just crazy. And the big worry is when things do go bad, which they will again. It's just normal sort of excess and that you have a correction. Is what do they do? If people are central banks have massive balance sheets, quantitative easing is becoming less and less effective. Fiscal expansion is, that's fine, but even that point it starts to get a challenge. I really worry about the environment. I just think we're going to get a fairly healthy correction, and I just think the central banks, even now they're talking about, not thinking about, talking about, tapering in 2023. Or it's incredible.
Oh, and we get little volcanoes that erupt constantly alongside any potential threat of tapering, and this is not a healthy market in that sort of circumstance.
No, and it's just everything's been, your sort of bonds at zero, negative nominal rates, negative real rates. It's just it's making sort of a lot of the, well, for people like me that have grown up through the 80s and 90s and 2000s, it's like how you think about managing markets is actually, it creates a bit of a challenge. It's all this. Just follow the Fed.
It is very much in that particular way. And I think the other challenge is because the Fed's providing still so much liquidity ultimately, or de facto providing liquidity, you're seeing huge amounts of asset price inflation. And people feel they've just got to get on board because they're concerned that inflation is going to hit them. And well, how do I deal with that? I just throw it into assets. And whether it's in the financial markets or the real asset, house prices, cars, collectibles, any rubbish is running pretty hot.
Yeah, and I think, and then you get all this sort of the political sort of fallout from that, which is Trumpism, et cetera, where you have, people living on wages that don't have the assets are just really falling behind. And so we do need wage inflation. We need a bigger share of the pie to be going to Labor rather than shareholder. And I just think the longer it goes on, the more the sort of the snapback potentially will be. And so thinking about it from a portfolio perspective, it is a real challenge. And I guess it's, the solution is you've got to start to get into more niche type investments. And I guess there's an advantage being a smaller fund. You have the opportunity to do that. But this big wall of money, I loved Alfonso's analogy about being in a nightclub.
Likewise.
Everyone rushing for the door. It's like
that's exactly how it is.
Right.
I got to ask you around the niche investments. It's something that is definitely front of my mind as I run my own personal portfolio and think about the current risks that are in the market. It's very much almost like a very low risk piece, a sort of a mid risk value oriented tilt, and then a very niche-y, almost biotech approach, things that can really go 10, 20, 30x. Right. I'm curious around how do you think about it, in terms of the current trajectory of financial markets with the amount of concern around risk, and then the potential to still capture this large upside because there is a lot of technological gain that's coming. How do you then sort of capture sort of the
and so that's sort of what we're doing with the climate fund. So we've got an exposure to developed markets and emerging markets, and so that's your broad market exposure. And then a portfolio of inflation-linked bonds and green bonds, just to give you that sort of that bond exposure. Both of those have durations of around 8, which is long duration. And so, that's That's a little bit of a worry, but I just don't know how far rates can rise. I just think, given the amount of debt out there, I can't see rates going up 2%. It's just unless the inflation genie really gets out of the bottle, and I'm not convinced that's going to happen. I think there is the school of thought about the supply bottlenecks being unblocked, and interesting Alfonso's argument about the zombie companies keeping excess supply out there. So that I'm not too concerned about that. And then, on the thematic side, you have these exposures to these new technologies. And I think that's the way to play it. I think it's, I would like to get some exposure if I had it, if the opportunity, as we get some scale into land/agriculture. I think that's an interesting area given, what's happening on the back of climate change as well, because you're obviously going to get certain areas where it's going to be far more difficult to farm, and other areas are going to have to pick up the slack. So I just think if you can tilt, and I think New Zealand's a good opportunity for that. I think we were potentially down here being a more favourable environment for producing protein, and I think that's an important part. So you can think about some of these long-term trends and try to play that as part of the portfolio, but it's getting the allocations right between those. But I think the way you articulated it actually is quite right. I think you have your portfolio dampeners on one side, your core, and then these playing these more sort of thematic things. It's interesting, isn't it? I don't think superannuation funds have been very good at diversifying over time. They've thought about every other diversification component, but time, and Roger Irwin at Willis Towers Watson used to talk about this. Let's play some long-term trends that may have a pretty low probability, but it could be quite significant. And certainly climate change is one of those, right? So if you can start to allocate a portion of your portfolio. So what we will do with our clients is they won't put everything into a climate change fund. I don't think that's, they'll put it partly into a growth fund and partly into climate. So climate will be almost a bit of a barbell in itself to their core part of their portfolio, which is run by a manager, which is far more dynamic in the asset allocation and the stock selection. So I think combining those two, but it gives you a component of your portfolio. It's really interesting. I think it'd be really nice from someone who's 35 investing in a superannuation product whereby your benefit is not to wait until you get to age 65, but you're using your superannuation as a means of actually trying to tackle some of the issues that you're concerned about. So it's not what do they call it? Impact investing. It's you obviously got to generate a competitive performance. That's a given the nature. But it'd be quite nice to have something there where you can actually feel that you're making a difference.
The word impact has really got multiple meanings. In my past life working with LGT, they do impact investing, and it's truly impact investing in developing countries like Haiti, Peru, all through Africa and so forth. And so what impact means to them is really how many people they touch, and return is not a key driver. It's sort of CPI plus a 1 or 2%, and it's really just almost a very, very defensive, conservative style investment for endowments and some very high net worth people. So impact is sort of thrown around a lot in the traditional institutional class. I'm not sure if it really does line up with that space. I want to also go back to your other conversation around super funds and what their struggle is. They've also got a huge struggle in the competitive environment. It's a highly competitive space. You're ranked every year, every quarter. And at the same time, you're trying to create a portfolio that makes sense for your members, but still try to manage your business risk at the same time, because the business risk is related to your performance risk. It's a very hard challenge.
Yeah, and it is. And I think, I think we've had this conversation before. I just think this obsession with performance is counterproductive. The analogy I give here is I've often given, if you want to go from Sydney to Melbourne, just plan to take 10 hours. Don't go hire a V8 car and try to do it in 6. Now, sure, you could do it, but the chances are you'll get a few speeding fines and maybe even kill yourself from going too fast. So I think, and what I'm trying to say there is actually, if you can create a portfolio where you say to members, I'm going to generate inflation plus 3 year in, year out. And if you want to get a retirement income of X, save Y per annum, so you own the outcome. You're not relying on generating this performance and chasing performance, because I think that the industry, it's just so perverse, because every statement about performance says past performance is no guide to future performance, and yet everyone sells on past performance. And it's just, and as soon as you've got good past performance, you're out there selling it, and so their members are chasing that performance. And invariably, you buy at the top and you sell at the bottom. It's just and Paul Costello, when he tried to bring in alignment of beliefs when we're talking about My Super. But there's a lot of political pressure there. If you're in a sector of the market that's doing really well from performance, it's like you don't want to downplay that. And so I think this sort of where the government's gone with this having this performance test, it's going to be counterproductive.
Well, you're also saying that if somebody misses by 50 basis points, that they're underperforming. It's fascinating that's considered underperformance, particularly with the amount of volatility that's in the markets. And you've also got a situation where people are, they're increasing returns because they're taking higher levels of risk. So, and there really isn't the I think, rebalancing and risk-adjusted style approaches to looking at these returns. Even the way they're talking about returns, there's still very, very little discussion on risk. And even risk as a methodology means many different things to many different people, right? You can have a lot of volatility, but drawdown risk is probably the biggest concern for people to have. And over a 30 or 50-year time horizon, how you think about drawdown risk is a very big issue.
Yeah, I completely agree. Look, and this is the sort of the challenges. But having said that, look, the Australian market has done phenomenally well. The industry there is world class. It really is, and it's so as much as you can say we're doing things wrong, they're doing far more right. And it's just I don't know what the market size is now, getting up to 3 trillion. Yeah,
3 trillion is fair with super plus also some of the wealth management groups. And that's another whole space that's very interesting, wealth management. There are a number of people that are high net wealth, limited by the amount of money that they can obviously put into their super because of the tax benefits, and the spillover money is now going into wealth. So, to that end, there's another exciting part of the marketplace that is getting a lot of attention, and that is the wealth space at the moment.
Well, that's exactly right. I think a lot of, the big retail banks, etc., a lot of the advisors and stuff are spinning out and going into these much smaller privately owned distribution businesses. And I'm not fully aware of the regulatory scrutiny of that side of the market. I don't know, but it's sort of, it's interesting. It's evolving rapidly, but I still, and the other point that we haven't talked about is this issue about retirement income and how that's sort of progressing. And I think the government's come out with a discussion paper on that. But I think, one of the things there is our market's obsessed. It's grown up as an accumulation market. And I think we have to get far more effective at communicating about what the income is going to be in retirement rather than what the capital value is. The analogy, if you had $1 million 10 years ago, that could provide you a very comfortable retirement in terms of dollars per year. You need, if you want $100,000 a year in retirement, I think you have to probably need $2.5 million or so, whereas 10 years ago, given where yields were, you need a fraction of that. So I think has to be a whole reframing of the way we communicate. And the other thing is volatility. You can, if you're a 25-year or 35-year-old and your portfolio goes down for 10%, if you're talking about an income in retirement at age 65, it has no impact. Yep. And so people start to understand volatility relative to the end game. It's just, so I think the industry, but as soon as everyone's obsessed about how much the capital value's gone up in the last 12 months compared to everyone else, you can't, you don't move, that doesn't work. That's what they focus on.
That's definitely a narrative problem. And I think the narrative is really around the role of income. And, you can be able to receive an income stream without having too much of a concern about the capital value, because capital prices, your valuation will change, right? That's just the way markets work. So that will move, but typically the dividend or income stream is pretty steady. And so that's what you should be thinking about doing. How do I build that income stream for retirement? And of
course, the other issue, of course, is as you're projecting, there's a lot of scope for manipulation and projecting. And so I think, the government could come out and sort of be quite clear on the rules of projecting, so that isn't manipulated to make you sort of look like you're going to get a much bigger income in retirement than you actually can. So I think, there's a separate challenge there, but I still think, we are it's a retirement industry. It's not an accumulation industry. And I think that needs to be a bit of a focus on that. But look, it's quite exciting being here in New Zealand. I mean, we're about 15 years behind the Australian market, but often it's like mobile phones. Some countries didn't go to landline, they went straight to mobile. So you can jump technology. So I'm going to stay very close to Australia just to see developments there, certainly in the wealth sector as well, just to see what innovation happens and, try apply it here in New Zealand. without having to go through a sort of a painful learning process. So it's a good test case. Actually, I have to say, I'm a bit sort of jaded today, having sat up most of last night to watch New Zealand clinch that the ICC cricket final. I still have a lot of my Aussie mates being a bit sort of sceptical about New Zealand being the champs, given that we never seem to be able to bat against Australia. But nonetheless, that was...
Oh, don't worry. You always win the Bledisloe Cup, so I don't think you should really be too upset.
It'll be interesting this year, though. I actually think Australia might be quite competitive. It doesn't look that on the Super Rugby form, but I think as a team of 15, I think you're going to be very competitive. I certainly hope so.
Fantastic. Well, it's been a pleasure talking to you again, Sean. Thank you very much for your time today, and it's great to have you back for the 100th episodes.
Yeah, look, I'm really, really proud to be number 1 and number 100. I sort of thought with the 100 there had to be a cricket analogy, so sorry I had to bring that in. I know it's quite painful for you Aussies, but it's been a pleasure, Alex. I've really enjoyed the conversation, mate. I look forward to number 1,000 maybe.
Feels a long way away, but who knows? Thank you very much.
All right, man.
Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Connexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.